Okay, welcome everyone. Hope you're all doing well. Great to see a few familiar names here, a few new names as well. So just give me a quick hi in the chat. Let us know where you're calling in from. And we'll get stuck into today's content. We should go for about an hour or so. Could be more, could be less, depending on how many questions. But just a quick reminder that everything discussed is for educational purposes only, is general in nature, and does not take into account your personal circumstances. So for those who don't know me, a little bit about me, I started trading options in 2004, which makes me feel pretty old now. That's me and my wife, Alex there, and my daughter, Zoe, who is now 15. And I've got a son, Jake, as well, who's 13. Been teaching options since 2010. So that was when I founded Options Trading IQ. So I've been doing this for quite a long time now. Also worked for 10 years in the hedge fund industry. For those that don't know, I lived in the Cayman Islands for 10 years working in the hedge fund industry, which was great fun. And now back in Melbourne. And spent thousands of hours researching, trading, and teaching options. So quick outline of what we're going to talk about today. Well, we're going to start with setting a good foundation and talking about how to find trade ideas and some of the tools that I use. We'll do a little bit of technical analysis using moving averages and money flow. We'll talk about how to get good fills on your trades. Then we'll look at the actual process of selling cash secured puts, which we can also then turn into the wheel. So just give me a quick yes or no if you've heard of the wheel strategy before. We'll do a bit of a deep dive into option delta as well. Probably won't go into too many of the other Greeks, but we'll definitely need to have a good understanding of delta for doing cash secured puts. So we'll talk about that as well. And then we'll get some examples going as well. All right, so the first tool I want to share with you is just stockcharts.com. I don't have a paid subscription here, but this is what I use for charting. Other people might have other platforms, that's fine. But basically, I try to keep it pretty simple. I've got three moving averages. The green one is a 21-day, the blue is 50, and the red one is the 200-day. If those are all nicely stacked in order like this chart is, they're all trending upwards and to the right, that's bullish. If they're trending down to the right, that's bearish. So try and stick to stocks trading above that 50-day moving average. We can see here with this one, really nice breakout here, then a little pullback to the rising moving average. That's a really good sign there. It had a bit of a big dip here down to the 200, but nice looking chart there. A couple of other indicators. I've got RSI up the top. I'll talk a little bit about RSI divergence and things like that. This one's called accumulation distribution, and this one's money flow index. So if you go to settings here, there's the moving averages. Then I've got RSI above the chart, accumulation distribution, and money flow below. These ones basically just tell us, is money flowing into or out of the stock? And what we want to see, if the stock's trending upwards, and I like to say price action is always the primary indicator. So that's the actual candles, this top section of the chart. Are we putting in higher highs, higher lows? Are the moving averages trending upwards? That's our primary source for technical analysis. And then things like RSI, accumulation distribution, and money flow are what we would call secondary indicators. So ideally, you want them lined up together. So you want your primary indicator of price action aligning with the secondary indicators, which it is in this case. The stock's trending higher, and we're seeing a nice increase in the accumulation distribution line, and the money flow line is quite strong as well. What we don't want to see is if the stock's trending higher and the accumulation distribution line is going lower. That can indicate that there's distribution going on and people are selling into the rally. So they're getting rid of their stocks on any strength. In this case, these lines are both staying fairly strong, so the trend is looking pretty good. Then we can look for things like divergence. I think Meta is showing a little bit of divergence at the moment. So here's a good example where it's in a bit of a choppy trend. It's had a huge run in the last 2 years, but the last 6 months or so, it's been a little bit choppy. And here, we'll just draw some lines on here. The stock sort of made an equal high. And you can see here, if we draw a same trend line on RSI, it's kind of trending lower. So it's gone from there to there. and the accumulation distribution line is also going lower. Now the money flow index is going slightly higher, so there's not full confirmation on all three indicators, but 2 out of 3 is pretty good. I tend to put a bit more weight on the accumulation distribution indicator as well. So that's telling me we've had this big rally here, but the strength of the rally isn't as good as it was back here. There's been a bit of distribution happening. People are selling into this rally. Okay, so that's one little thing that I would look for. That was a nice little short there on Meta for the last couple of days. And that's basically it. Keep it pretty simple. Don't need hundreds of indicators. The other thing you can do with stock charts is get what's called a candle glance view. And I'll share this link with you in the webinar chat, so you can go and look at that for yourself. So this will be under these predefined groups, Dow stocks. So these are some of the most highly liquid stocks in the US, some of the best stocks for trading options. And we can just have a really quick look. We've got, we're sorting by RSI, so we've got the most oversold at the top. Intel there's had a pretty bad run, so deeply oversold. Microsoft, a little bit oversold. So this is going to be a good way to find blue chip companies that have had a bit of a bad run, and they might be a good little value play. You've also got a 50 and a 2, actually is it a 50? I think it's a 50 and a 200-day moving average. So the blue one's the 50, the red one's the 200. You can get just a quick look of, Goldman's obviously in a nice uptrend, JP Morgan's in a nice uptrend, Coca-Cola as well. I see Mark has a raised hand. If you've got a question, just type it into the chat. And then you can, so that's the Dow stocks, and then you can also do your own set. Unfortunately, they only allow you to have 12 stocks, but you can basically just put your 12 in here, and you can have a quick look at the 12 main stocks that you might be interested in. So that's a nice little way to kind of keep a quick eye on the market. Another tool I use is Market Chameleon. Again, I only have a free subscription here, but this is a good one for checking earnings dates. So we've got NVIDIA here reporting earnings on the 28th after the market close, and we've got an expected move of about 11.2% up or down. So this is important information when a stock's coming into earnings, and it will give us, with a free account, it'll give us the last 3 results as well, what the expected move was or the implied move, and this is the actual move. So that's a nice little tool for monitoring earnings dates. Probably won't get into VIX term structure too much today, but VIX Central is a good one that you can monitor as well. Again, all free. FinViz also free. They have some really nice, I monitor the futures on here, but they also have some nice stock screeners as well. Got a couple of simple scans here for large cap stocks that are above the 50 and above the 200-day moving average. So that's a way to kind of find some strong stocks. And then you can sort of hover over the ticker and you can get a quick little preview of the chart as well. So that is a nice little tool as well. One of the few paid tools that I recommend is Bar Chart. It's about $20 a month. This is how I find a lot of trade ideas. I'll look for example, stocks crossing above or below a 50-day moving average, large cap stocks. So a lot of sell signals today. So a lot of stocks breaking below 50-day moving averages. If I filter by call volume, I'll get sort of the most liquid stocks. And then from there, I'll go and drill it down and look at the actual chart and see if it might be a good chance for making a trade. See that it's breaking below the 50-day moving average. All right. Now, in terms of getting good fills, we want to stick with highly liquid stocks. So let's look at a quick example of Apple. Let's say we were going to sell some puts on Apple. We use, let's say, an 18 delta. You can see the bid-ask spread there is pretty tight, $1.56 to $1.61. We can probably get filled pretty close to the midpoint there. Open interest of 18,000, volume for the day of 954. So really easy to get filled on that put sale at a good price. If we look at a different stock that's a reasonably popular stock, but it's not great for trading options. Try and find a similar delta, about an 18 delta. So there we go. You can see there are only 13 contracts traded for the day and only open interest of 50. And look at the wide bid-ask spread, 665 to 1090. So we want to definitely avoid stocks like this. Hey, Robert, this is Interactive Brokers, my broker platform. So avoid illiquid options like this because you're going to suffer what's called slippage, which is basically not getting filled at the midpoint of the spread. You might try and sell that option for 880, but you might only get filled at, say, 850. And all of a sudden you're down $30 in the trade before you even get started. Okay, so definitely avoid ones like this. Why the 18 delta? As just was an example. I just sort of picked one at random. We'll get into that when we look at some actual cash secured puts. Okay, any questions so far? All right. So let's talk about the actual process of doing cash secured puts now that we know a little bit about how to find trade ideas and the tools, getting good fills. So why would we trade cash secured puts? It's similar to a covered call strategy. We'll have a look in a minute. It's actually a little bit less bullish than a covered call strategy. And there are some slight differences in returns, which is quite interesting. You might find something you didn't know about when we compare cash secured puts and covered calls. It's a longer term strategy with potential for monthly income, or you could even have weekly income if you're going to be a bit more active. And we'll look at some examples shortly and talk about when and why we might use weekly options versus monthly options. It allows you to buy stocks for less, so you can sell a put below where the stock's trading. If the stock comes down and you get filled, you're buying it at a lower price than what it was previously trading at. And it's a good idea to have strict trading rules to try to avoid big losses, and we'll go through some of those as well. So this is the wheel flow chart. It might look a little bit confusing, but it's actually fairly simple. So we start off at step one, we find a stock that we like, and we sell a put option. We won't get into strikes or deltas or anything just yet, but we sell a put option. If the stock goes up, that put expires worthless. We keep the premium, the option gets taken out of our account, and we can start again on the same stock, or we can move on to a different stock. If the stock goes down, we get assigned. So now we own 100 shares of the stock. Our effective or net cost basis, or our purchase price, break-even price, is the put strike less the premium received. Now at step two, we want to sell a strangle. It says straddle, but we actually want to do a strangle. So we want to sell a call above where the stock's trading. So that's a covered call based on the 100 shares that we own. We want to sell another put as well, and we're going to take ownership of 200 shares if we need to, if the stock keeps dropping. After we've done that, if the stock goes up and finishes above our sold call strike, our 100 shares get taken away, our put expires worthless, and we're left with a flat position again. And we've collected 3 lots of option premiums, plus any dividends that have been paid while we've been holding the stock. If the stock continues down and goes down below our second put strike, we're going to get assigned on another 100 shares. We now own 200 shares, and we're kind of dollar cost averaging into our position. We're buying at a lower price, reduces our net cost basis. We've also collected 3 lots of option premium plus any dividends. Okay, so now we move on to phase 3, is where we sell 2 covered calls against those 200 shares, and we just keep selling those calls until eventually the stock goes up through the call strike, shares get called away, and we can start again. Now, there is a little bit of flexibility in these, in the process. For example, if the stock has had a really big decline, at step 3, we may want to hold off on selling covered calls, and we might want to wait for the stock to recover back up towards our net purchase price before we start selling covered calls. Whenever we're selling a call, we always want to do it above our net cost basis. We never want to sell below our cost basis, because then if we do get our shares called away, we're actually getting them called away at a loss. But you can see at this point, by stage 3, if those calls expire worthless, we've collected 5 lots of option premiums plus dividends. We've got the first premium from selling the put. Here we sold a put and a call, and here we've sold 2 calls. So 1, another 2 is 3, and another 2 is 5 lots of option premium. So you can see how over an extended period of time, we're generating quite a lot of option premium and dividend from our underlying stock position. Now, the other thing that you can do at phase 3, if the stock does go up through your call strike, but you don't want to have the shares called away, you want to hold on to them for the long term, you can actually just buy the call back to close. But and I'll show you a couple of things to keep an eye on in terms of early assignment. You might buy those calls back at a slight loss in order to hold on to your shares. The reasons you might want to do that is because if you've made a decent profit on the shares, you might not want to sell them and trigger capital gains tax, right? And if you buy the calls back at a slight loss, that can actually help reduce your taxable income, because you're taking a loss on the a realized loss on the calls, and you're still keeping your underlying stock position. Yes, +3 and +5 preem means premiums. So 1 option premium here, another 2 option premium here is 3, and another 2 option premium here is 5 premium. And you can get even more if the stock stays below your covered call at phase 3 and the call expires worthless, you can sell another 2 calls and just continue on. Couple of examples to go through, and this will sort of illustrate the power of this strategy. So this was one on EWZ. The stock started at 32.77, sold the initial put at 31. That got assigned, sold a second put at 25. They both got assigned. So my net purchase price was 28. The stock had gone all the way down to 22. You can see here at this stage, 18th of September, when I was assigned the 200 shares, I didn't actually sell any calls yet. I waited for the stock to recover a little bit, and it wasn't until March the following year when I started selling calls again at that 28 strike, which was my net cost basis. So I sold some more puts here. I was willing to go to sort of 300 or 400 shares. So selling more puts, selling calls. Eventually, they got called away at 28.50. You can see over the life of the trade, the stock went down initially and then recovered, ended basically where it started. So the stock has gone down 0.06%, basically flat. I've made a return of 15.90, or about 20%, in about a year and 3 months. So that's the power of the wheel strategy. Even though the stock has been flat over that time period, I'm up 20%. Now, that doesn't mean I wasn't sitting on unrealized losses when the stock was here, or the ETF, but I was pretty confident it was going to recover, and you just have to play the waiting game at this point. And in actual fact, the return was probably slightly higher because I haven't included any dividends here. Holding the stock for quite a while, about a year, so there would have been some dividends there as well. All right, the next example is one I like to share because it's a pretty extreme example. It's probably about as bad as it could possibly get with a wheel trade. I guess it could get worse because the company could go bankrupt, so you've got to be careful of that as well. That's why you want to try and stick to blue chip companies, and particularly ETFs as well are great, because generally ETFs are not going to go to zero, right? So this was a tough trade, but it worked out well in the end. I was in a massive hole, but worked my way back. Ignored or didn't have any sort of stop loss in place. So a good little lesson for you there. But it did work out okay in the end. Finished with a 20% return compared to the stock going down 42%. So I won't go through this in detail. Again, there's a little bit of flexibility here in terms of when I'm selling puts and calls and all that sort of stuff. Don't worry too much about the details because there's a lot of detail here, but basically the main thing to look at is when I started this wheel trade, GE was at 32. And it did take 2.5 years to play out. So started in April 08, ended in December 2010. In a pretty big hole here when the stock had dropped from 32 down to 8. But it's kept buying shares, selling puts, selling calls, collecting dividends. And you can see here the stock's gone down 42.71% from basically 32 down to 1830. And I've ended up with a gain of 1800. So I'll provide the slides. You can look through those details if you want in your own time. One rookie mistake that I see a lot of people making is getting sucked in by high volatility stocks. Yes, the premiums are nice and juicy, but they're juicy for a reason, and that is risk. Don't get me wrong, cash secured puts can work on high volatility stocks, but you need to know what you're getting into, be prepared for a bumpy ride. And even just in the last few years with the COVID drop, the November 22 drop, some growth stocks and high volatility stocks were down 60, 70%. So yes, the premiums are really high, but they're high because the stocks are high beta, high volatility, and they can have these massive moves. I'm not saying don't do it. I'm just saying understand what you're getting into and make sure it fits your risk profile. For me, I don't want to be doing those high volatility, high risk stocks anymore. I do a lot of ETFs now. You could do this on the Qs or SPY, IWM, any of the sector ETFs. I really like the country ETFs. Plenty of options out there if you don't want to do individual stocks. Another good tip is to stick to stocks above their 200-day moving average. Throughout history, stocks that have had big declines have done so when they have been below the 200-day moving average. A lot of fund managers have specific rules and covenants that they can't invest in stocks that are below a 200-day moving average. So if a stock breaks below a 200-day moving average, it can really lead to a lot of selling. And you can see here the S&P 500, the big declines, the two big bear markets that we had the initial breakthrough, the 200-day moving average, a counter trend rally to retest. And once that moving average started to turn downwards and the stocks were struggling to get above it, that's when the big declines happened. Same here. We had a bit of noise here around the top. Broke through the 200 here and here, but it wasn't really until the 200-day started to turn lower and stocks remained below, retest and a fail at that level, that's when the big declines happen. So just keep that in mind. Question here from Dave, do I differentiate between high vol stocks and a high vol market? Yeah, definitely. I mean, a great time to do cash secured puts is when volatility is high in the overall market, but I would still stick to low beta stocks, which are generally going to have lower volatility. But that's when the concept of IV percentile comes in. So, you might look at a stock like Pfizer, and that might have volatility of, say, 30%, which is really high for that particular stock. Whereas for a stock like Nvidia, volatility of 30 is really low for that particular stock. See if you raised hands. Has anyone got any questions on that? Just let me know. Just type it into the chat. So we'll look at some key differences with those examples as well in a second. All right, so let's go and look at some examples right now, actually. So we're going to look at two examples. The first one's going to be a high volatility stock, PLTR, the one we looked at earlier. Now we're going to look at a weekly. We're going to try and, now I'm going to use a 35 delta. No particular reason, just to try to keep it consistent. We're going to look at a more or less a weekly trade. We'll look at a 50-day trade. I haven't got a 35 delta, but I'll use 32. And then we're going to look at, that'll be about a 6-month trade. All right, so if we were to sell that put option, let's just hide these two for now. We're going to receive about $70 in premium. We're going to be on the hook to buy the stock at 30 if it drops below that price. Now this is Risk Navigator. part of interactive brokers. I always look at this when analyzing any option trade. Now, there's plenty of other pieces of software out there, but I really like Risk Navigator and interactive brokers. It's a bit overwhelming for people when they first look at it, but pretty simple. So we've got our blue line is our profit and loss at expiration. The purple line is what we call a T+0 line. How does the trade look as of today? And as we get closer to expiration, this purple line will slowly come up towards the blue line. Okay, so $70 is our max profit, break-even price $29.30, which is the strike price less the premium. We don't really, there's not a lot more we can talk about with the profit and loss graph, right? It is what it is. But the one thing I do go through with each trade is I have a little cash secured put calculator in Excel. Some of you might have a copy. If you don't, I'll send it out when I send out the replay. All we need to fill in is these cells in green. Okay, so we're going to put in our expiration date, stock price, our strike price, and the option premium. Key things I'm looking at here are these two numbers. So we've got a nearly 5% decrease to our break-even price of $29.30. And we've got an annualized return or potential annualized return of 79%, which I think you'll agree is pretty high. Now that's because it's a high beta, high volatility stock, 51% volatility here on this particular option. All right, let's compare the slightly longer term one. So that's October 18th. So here we're getting a larger decrease to our break even because our strike price is a bit lower, and we're getting a lower annualized return because it's taking us longer. Even though the premium's higher, it's taking us a lot longer, 5 times as long to get that premium. So our annualized return is lower. Still pretty good. Yes, this is my calculator. I'll give you a copy. All right, let's look at the last example. This one. Okay, so now, see how this is working the further out in time we go? We're getting a higher decrease to our break even, but a lower annualized return. Now, I'm not saying this one's the best because the return's higher, and I'm not saying this one's the best because the decrease to break even is the lowest or the biggest. It's all about finding a style that works for you. And once you get to know your underlyings, you'll start to know, is this a good annualized return for this particular stock? The other thing to consider, if you're going to do this version with only 11 days to expiry, it's going to take more active management, okay? Because you're going to be in the trade for 11 days. You might take profits halfway through. You might get a sign, then you've got to move to phase 2. You're going to be a lot more active. So you're going to have to keep an eye on things a lot more. That might be hard if you're pressed for time, you're working full time, got kids, all the usual stuff. And it might be harder to manage. Yes, the return is the highest, but it takes more work. This is a good little sort of in the middle option, not as active. And this one is very, very hands-off. We're not really having to do much at all. So it's about finding a style that works for you and a return potential that you're happy with. All right, let's compare now PLTR. Let's make a copy of this. And now we're going to compare Pfizer, a stock that's trading around about the same price, but obviously a much lower volatility. So 33 delta. Then we've got October. We haven't got Feb, but we'll go January. See how PLTR is trading with 48% volatility on the actual stock, and then this one's trading at 51% volatility. We're going to see a big difference here in Pfizer. The stock's only trading at 21% volatility And this one's at about 28%, 21% volatility as well. So now trade date's the same, price is 28.91. Much lower annualized return. Okay. Again, not saying one's better than the other. This one's just going to be a bit less stressful, maybe, right? And this one, so we've got now only a 13% annualized return. Now we're getting 9% margin of error and only a 10% annualized return. Okay, so much lower returns in Pfizer, but that's because the volatility is lower. The beta is a lot lower, okay? Both of those could be good underlyings to do this on. Just depends what you're looking for. All right, any questions so far? Now, another thing you can do, and this is where we kind of get into volatility term structure. And actually, I might just try and set this up on the other screen. Good question here from Rob. When we're looking at delta, should we look at theta as well? I don't really look at the theta, but I do take that into consideration when I'm looking at these annualized return numbers. But I don't look at the actual value of theta. The main thing I would look at is the delta and the actual strike, the decrease to break even, and the annualized return. That's pretty much it. No problem. Okay, so this is another little cool thing that we can do with bar chart premium. We get, oh, actually, I think it's extra bar chart Excel. You can actually look at the term structure of an individual stock. So what we're looking at here is the implied volatility across different expiration dates. Okay, so this week's expiration, next week, so on and so forth, out to 2026. Now, why would there be such high volatility here? Can anyone tell me? Really high volatility in the short-term options and lower volatility in the longer-term options. Let's compare that with a different stock. Yeah, earnings, exactly. Yep. So there's huge volatility around the earnings announcement in a couple of days' time. Let's compare to Apple. Now, Apple's already reported earnings, so there's a bit of noise here, but generally there's not a whole lot of difference here between short-term and long-term, but it is generally lower at the front and higher the further out we go. That's sort of what you'd see normally for a stock. And then just before earnings, you're going to see this type of shape. So we can actually use that to our advantage. If we like NVIDIA, it's actually a great time. Obviously, there's risk because everything's a trade-off with options, right? High return equals high risk. But let's say we like NVIDIA. Earnings are on the 28th. These expire after earnings. Huge implied volatility. There's our 35 delta. We'll kind of keep it consistent with the other examples that we've been looking at. Now, this isn't for everyone because it is riskier to do this around earnings, but risk and return are always interrelated. We're at 121, 445 premium. Pretty decent decrease to our break even and a massive annualized return potential. Massive. Because the stock's trading with implied volatility of 71%, but this option, because of the earnings, is trading at 132% volatility. So volatility is massively overpriced, and it can be a good time to do a cash secured put on Nvidia if you like the stock and if you're happy to buy it at 121. Now, the risk is, of course, the market might not like what they hear and the stock could drop 20%. That's possible. Risk and return, always interrelated. High return potential, high risk. But certainly that's a pretty unbelievable return, right? Even going out to the September expiration, our returns are still going to be pretty high. There's our 35 delta. Still pretty high, 85% return. Our strike price is more or less the same, but we've got an extra 21 days to wait. So if I'm happy to buy Nvidia at around 120, I'm way better off doing this one compared to this one, right? And look at the difference in vol. And that's that contango that we're talking about. Oh, sorry, backwardation it is. If you've heard that term, that was the term structure we were looking at. Really high volatility in the short-term puts compared to the longer-term puts. So if you like Nvidia at around 120, you're way better off doing this one than this one. Any thoughts, comments, or questions on that? Okay, so if we were to do, say, this one, if Nvidia drops below 121, we get assigned, we buy shares at 121. Depending on where the stock's trading, we might sell another put down at 110, and we might sell a call up at 125. Then if Nvidia keeps going down below 110, we buy another 100 shares. Now we're selling calls. What would our net price be? About 117.50. We're making sure we sell our calls up at, say, 120 or above. The other thing you may consider doing is having a bit of crash protection. Rather than going with a naked cash secured put, you might want to just buy a really cheap out of the money put just in case. Now, unfortunately, because of earnings, everything's still pretty expensive, but you could potentially buy that. Now, a lot of times buying this is going to be a waste of time. It's not going to help you, but just on the off chance Nvidia drops, your losses are capped at 105, but most of the time that's not going to be worth it. Question here, how to apply this with a stock that continues to fall over time? Examples, WBA and EL. Yeah, you want to try and avoid situations like that. Again, using that 200-day moving average as a guide is a good idea. So, for example, Walgreens, you want to try and avoid dying companies, dying industries. We look at Walgreens. We're going to have to even go back further. It's been in such a bad downtrend. Look at that. It's being distributed so badly. People are selling. People aren't buying the dip. There's distribution occurring. Let's see if we can see. I'm going to have to actually keep this at daily, which is going to make it a bit messy because I want to try and see where it crossed below the 200-day moving average. So you can see here, even when it was up at about 40, once it got below that 200-day moving average and the 200-day started to trend downwards, you just want to avoid that scenario altogether. Robert says, I seem to like 35 delta. Any reason? No, it's just kind of a good balance between generating decent premium and also having a reasonably decent break-even price, a decrease to your break-even. So yeah, definitely want to try and avoid situations like this. And that's where ETFs can be a really good option. Returns are going to be lower, but you're going to avoid situations like this. All right, so I've got a template as well for tracking trades, which I'll go through. And I'll give you all a copy of this after the webinar. So this is one that I've been doing for a while now. So EWA is a country ETF. It's the Australian ETF. It's been amazing for the wheel, to be honest. Pays a great dividend, 4.5%, 5% yield, pretty low volatility. And it kind of just bounces around between the high teens, low 20s, up to the mid 20s. So it's great. It's bouncing around here through this period. You're selling puts, you're getting assigned, you wait for it to bounce, you sell calls, you're collecting dividends, you keep adding as it drops. It's an ETF, so it's probably not going to go to zero. So started in Feb 2023. Actually started with a cash secured put, then I had some capital to allocate, ended up just buying 1,200 shares. And basically what you do is anytime anything's closed, you zero it out. And then this is just the current value to close everything. I've got, selling puts, selling calls, collecting dividends. And basically got these positions open, 1,400 shares. Oh, the other thing I'll do sometimes is sell less calls than I own of the stock. So that will allow me a little bit more upside appreciation. So you can see here, I've got 1,400 shares, but I'm only selling 12 calls. Then you just put in the value to close of the open option positions. This will fill in automatically because it's the stock. Beauty of Excel, you can actually just automatically bring in the stock price. So you can see here, starting price was 24.02 back in Feb 2023, up about 7.5 grand or about 19%, even though the stock's only gone up 7.7. And then I've got a little calculator here as well. I'll kind of go through. This example's maybe a bit complex, but basically you take, let's say we just look at these first few examples, go back to the early part of the trade. So I've bought those shares, bought shares there, bought shares there. So that's what I would call my gross cost basis, right? Equals that divided by 1,400. So that's my gross cost per share. But then I want to take that number and I want to subtract out any premium and any dividends that I've received. So this is actually my net cost after option premiums and dividends. Does that make sense? Do you understand the difference? And this is helpful when I'm deciding where to sell my calls. Generally, I'm going to want to sell them above 23, but if I'm really wanting to get out of the position, I know that I can sell them at around 22, 22 and a half and still come away with a slight profit. So that's a little calculation I'll do, which is kind of hidden a little bit here, but this is this sort of thing here. Another example, EWU, this one, my shares got called away a while ago, so I'm now just in the selling put phase. So the stock's up at 37, so that's probably going to, well, it's out to January, so it might expire worthless, might not. But again, stock's up about 14%, I'm up 23%. EWZ, another one I've got going on, the stock's down 12%, and I'm just around my break-even price. So hopefully pretty straightforward on how to use that. I've got a couple of Australian ones that I've just started as well, so I've got those there. And last example, this has been a tough one, but the stock's down 41%. I initially bought shares at 45, bought some more at 28, bought some more at 27, bought some more at 24.5. Lots of option premium and dividends. Right. And only down 1% on the trade compared to down 42% on the stock. So I'll give you a copy of that, and then you can just start your new one here. These are kind of the data tab here. These are kind of what's the word? You have to select one of these. You can't type your own in, but either way, you can update those on the data tab if you want. But yeah, basically selling to open a cash secured put, that's going to be your first step. Your symbol, expiration date, strike price. Hopefully pretty straightforward. All right, any questions? That's pretty much all I wanted to cover today. So I'll get you the copy of the slides and the wheel template here. And I'll send the replay out to everyone so you can watch that again if you feel the need to. But I hope you enjoyed it. If you've got any follow-up questions you think of after, feel free to just shoot me an email, info@optionstradingiq.com. Question here, how do you decide your position size for your portfolio for each tracker? Also, how many open positions do you usually have on different tickers at the same time? Yeah, each to their own in terms of position size. But you might want to keep each position to 5%, something like that. Depends on the stock, if it's a stock or an ETF. You know, you could do this on SPY, and that could maybe be a really larger part of your portfolio. Whereas if you're doing individual stocks like PLTR, you'd probably want it to be a little bit smaller. And how many at the one time? Probably want to have less than 5 to 10. But again, it depends on how much capital you've got too. If you've got a small account of only 50,000, it's going to be quite hard to do the wheel, to be honest, because it does require quite a bit of capital. Think about NVIDIA, the example that we looked at. If you get assigned on that first lot of 100 shares, that's 12 grand. On another lot at say 11, 110, that's another 11 grand. You're looking at 23 grand to buy 200 shares. So then you've got to think about how big is that in terms of your total account size. You know, if you've got a $100,000 account, that's 23% of your account tied up in that one stock. So a lot of it will depend on how much capital you have as well. Oh, one other thing. What we can do as well, if it's a stock that doesn't pay a dividend, so I had one on Uber recently, and let's say the stock's dropped. I know Uber's kind of rallied recently, but you know, let's say we sold this one and Uber has dropped below our strike price and it's looking like we might get a sign, maybe we're getting close to expiration. Sometimes what I'll do is I'll actually roll. So rather than waiting and taking assignment at 74, I might roll it out to October and I'll delay assignment and maybe wait for the stock to recover. And you can see here, I could roll that out a month and I've lowered my strike price by $1.50 and I've received a credit of about $45. So I buy that one back for $2.95. I sell that one for $3.40, net credit of about $40, and I've moved my strike lower. So that's a nice little trick you can do as well if you're not quite ready to take assignment yet. Yeah, Dave, how about adjustments? Yeah, that's kind of one adjustment. Probably not too many others that I would use. Hey, Craig, I've got to do a couple of courses. The next one is Options Income Mastery starting end of September. So that's a 1-month course. We'll do 4 live webinars. We'll look at about 10 case studies on different strategies. So we'll look at the wheel. We'll look at credit spreads, condors, calendars, butterflies. So keep an eye out for that one. And then I also run a 12-month program called the Accelerator that just closed for enrollment earlier in the month. That'll be open again in November. So if you're on my email list, I'll email you when those are open. All right. Thanks, everyone. Appreciate the kind words. Happy to stick around for another couple of minutes if there's any other questions. But if not, have a great evening. And if you do think of questions afterwards, yeah, feel free to email me. Thanks, Vladimir. Hope it helps you. Best of luck with your trading. All right, I might sign off. Doesn't seem like there's any other questions. So thanks, everyone. Take care, and I'll talk to you soon.